Good morning, everyone. Well, it's central bank week again. Once again, we have several central bank meetings coinciding. On Tuesday, we have the Reserve Bank of Australia. On Wednesday, the Bank of Canada. On Thursday, the Bank of England. And the main event, the European Central Bank. No change in rates is expected from the RBA, which has already said several times that it expects a period of stability in interest rates. Rather, the market will focus on the RBA's view of the labor market, its assessment of whether investment in the non-mining sector is likely to pick up the slack from the mining sector, and also whether the exchange rate remains high by historical standards, as they said at their last meeting. Aussie dollar has been quite stable over the last month. For Canada, too, the market unanimously expects no change in rates. The Bank of Canada's central view is that it expects a gradual strengthening in the fundamental drivers of growth and inflation in Canada, which, it says, hinges critically on the projected upturn in exports and investment. So far, the export part is coming through, but investment's fallen for 4 out of the last 5 quarters. So the Bank of Canada may try to talk down the Canadian dollar, which has been the best performing G10 currency over the last month. The Bank of England meeting, likely to be a non-event as usual. We won't learn anything interesting from the meeting until the minutes are announced on June 18th. That leaves the main event of the week, the month, the quarter, or maybe even the year, the ECB meeting. The ECB is widely expected to loosen policy further. According to a poll by Nomura, 95% of the firm's clients expect a cut in the refi rate, and 89% expect a negative deposit rate. The market's less certain, though, about further measures, with only around 1/3 expecting another long-term refinancing operation, and only 10% expect quantitative easing. The problem with all these measures is that they won't have that much impact on the real economy. I'm concerned that the ECB's moves may be interpreted as too cautious, and the euro could actually strengthen after the announcement if the measures are considered too little too late. I suspect we're likely to see further loosening measures later in the year after this week's proved insufficient to restore growth to the eurozone. As for today, it's PMI day. China started things off on Saturday with its official manufacturing PMI, which rose to 50.8 from 50.4. We get the manufacturing PMI data from several European countries and the US today. The final figure for Germany, France, and the Eurozone as a whole, as usual, is the same as the initial estimate. While the UK manufacturing PMI for May is expected to have risen slightly, that could help to boost the sterling today. In the US, the ISM manufacturing index for May is expected to have risen, which could strengthen the dollar. Besides the PMIs, we get Germany's preliminary CPI for May, which is expected to have slowed. Normally, I'd say that could feed through to expectations of ECB easing and hence a weaker euro, although, as I mentioned, most everybody already expects the ECB to move this week, so a change in policy is probably fully discounted by now. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gidler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.